Imagine you are holding a handful of sand and every second it is slipping through your fingers while you stare at a screen telling you that you are becoming a millionaire. You feel the rush of the green numbers and the thrill of the climb, but you do not realize the floor beneath you is vanishing. We have entered the era of the ghost economy where your profit is just a polite way of saying your money is dying. Today we are going to tear down the illusion and show you exactly where the real value is hiding before the clock hits zero. Hey guys, I am Sean. Today we are looking at the end of money as we know it. In the next few minutes, I am going to explain why the roaring stock markets of the last decade are actually a warning sign of a dying system. And I will give you the strategy to move from being a victim of inflation to a master of the new paradigm. You are going to gain the clarity needed to protect your family and your future in a world where the old rules no longer apply. Let us start with the truth that most experts are too afraid to tell you. Everything you think you know about the stock market is a haunting reflection of a past that no longer exists. Think back to the year 2000. The world was obsessed with the digital frontier, and the Nasdaq index was screaming toward a peak of 5,100. People were quitting their jobs to day trade, and everyone felt like a genius. Then the lights went out. The index did not just fall, it disintegrated. It dropped to 8% and turned fortunes into dust. But the real tragedy was not the crash itself. It was the time. It took 15 long, agonizing years just to get back to that same 5,100 mark in 2015. For over a decade and a half, millions of people were just running in place, trying to catch a ghost. Since that recovery in 2015, we have seen something even more strange. The Nasdaq went from 5,100 to over 23,000 by the end of 2025. On paper, it looks like the greatest era of prosperity in human history. We are told this is because the economy is booming and technology is saving us. But if you look under the hood, you will find an engine that is barely turning. This is where the deception begins. Most people believe the stock market is a mirror of economic health. They think that if the stocks are up, the country is getting stronger. This is a fundamental misunderstanding of the world we live in today. When we look at the actual growth of the economy, the numbers tell a story of decline, not progress. In the 1960s, the average annual growth was 4.4%. Even in the 1970s, which we remember as a time of crisis and stagnation, the growth was 3.2%. Fast forward to the era of the great stock market boom. In the 2000s, growth fell to 2%. In the 2010s, it was 2.3%. And as we sit here in the 2020s, we are looking at an average of just 2.1%. We are growing at half the speed of our grandparents, yet our stock portfolios are 5 times the size. How do we explain this gap? Imagine you are a captain of a ship and you are measuring your speed by looking at the waves. If the waves are getting bigger, you think you are going faster. But what if the waves are only getting bigger because the ocean is being hit by a massive storm? You are not moving faster. The environment is just becoming more volatile. The stock market is not rising because we are producing more or becoming more efficient. It is rising because the value of the dollar we use to measure it is being systematically destroyed. In the 1970s, the central banks could not just print money to save the market because high growth would have caused immediate and uncontrollable inflation. But in our modern era of low growth, they found a loophole. Because the real economy was so sluggish, they could pump trillions of dollars into the system without seeing the price of milk double overnight. Instead, that money flowed directly into assets. It went into tech stocks. It went into real estate in cities like New York and Sydney and Toronto. It created a massive bubble of perception that we call wealth. This is the secret that the elite do not want you to focus on. The government and the central banks have been using the stock market as a distraction. As long as your 401k looks like it is growing, you do not complain about the fact that your salary can no longer buy a starter home. You do not notice that the middle class is being hollowed out. Now, we are living through a period of artificial life support where the medicine is just more debt and more printed currency. Think about the sheer scale of the money printing since the pandemic. We saw the government spray trillions of dollars into the economy, and we are seeing that trend continue under current administrations. They are trapped in a cycle where they must print to keep the system from collapsing. This has created a world where the stock market is now completely disconnected from reality. It is no longer about which company makes the best product. It is about which direction the river of liquidity is flowing. But there is a limit to this magic trick. We are hitting a wall of physics and biology that no amount of printed money can overcome. The resources required to fuel this growth are becoming more expensive, and the people required to do the work are becoming fewer. We are moving into a phase where the illusion can no longer be maintained by simple math. What happens when the people in charge realize the game is up? What happens when they decide that their own survival is more important than your savings? We are already seeing the signs of the next great shift. In 2026, we are facing a changing of the guard at the Federal Reserve and a political landscape that is ready to sacrifice the currency to keep the asset prices high. This is the moment where the river turns into a flood, and if you are not prepared to move to higher ground, you will be swept away with the rest of the old world. If you think the volatility of the last few years was a fluke, you are mistaken. It was a rehearsal. The real show is about to begin, and the stakes are everything you have worked for. Before we dive into the specific forces that are pulling the strings of the global economy, I want you to ask yourself one question. If the dollar in your pocket lost half its value by tomorrow morning, would you be a victim? Or would you be an owner of the things that the dollar is trying to buy? The answer to that question will define your next 10 years. Because the window to protect yourself is closing faster than you think. In the next chapter, we are going to look at the ghost in the machine and the global experiment that went horribly wrong. The year 2008 was the end of the world as we knew it, but we were too busy surviving to notice the funeral. That was the year the central banks of the world stopped being referees and started being the players, the coaches, and the owners of the stadium. They invented something called quantitative easing, which sounds like a boring academic term, but is actually the greatest magic trick ever performed. It is the process of creating money out of thin air to buy up debt and keep the system from flatlining. This was supposed to be a temporary emergency measure, but once you start feeding a patient pure adrenaline, you cannot just stop. Take a look across the Atlantic at Europe, because they are the canary in the coal mine for what is happening to all of us. People often say that Europe is a dying continent, and from a growth perspective, they are right. In the 1960s, the Eurozone was a powerhouse growing at 5% every single year. By the 70s, that dropped to 3.5%. And by the time we reached the 2020s, that growth had withered away to a pathetic 1.1%. If you ran a business with those numbers, you would be looking for an exit strategy. But here's the mystery. Despite having almost zero real economic growth, the European stock markets did something miraculous. The Euro Stoxx 600 index hit a high in the year 2000 and then spent 15 years in the wilderness. By 2009, people were screaming that Europe was finished, but then the European Central Bank started the printing presses. They flooded the streets with euros, and suddenly an economy that was not growing at all saw its stock market jump 40%. It was a miracle built on a foundation of paper. This leads us to the great misunderstanding. Most people believe that for stocks to go up, the companies must be selling more products or becoming more efficient. The truth is that a company can be failing in every real metric, but as long as the currency it is measured in is losing value, the stock price will go up. If you have a house and the neighborhood goes to ruin, but the government prints so much money that a loaf of bread costs $100, your house price will technically go up. You are not richer, you are just holding a larger number of worthless units. This artificial inflation of assets has created a monster called K-shaped growth. You have probably heard this term in passing, but let us break it down for what it really is. It is a class war disguised as an economic chart. The top 10% of the population who own the stocks and the real estate are flying on the upward arm of the K. They feel wealthier than ever. But the bottom 90% who rely on wages and savings are on the downward arm. Because growth is so low, their wages are stagnant, but because the money printing is so high, the cost of the life they want is skyrocketing. This is why you see the streets of Paris and London and Berlin burning with protests. It is not just about a tax or a retirement age. It is about a deep soul-crushing sense of relative deprivation. The average person looks at the stock market hitting all-time highs and then looks at their bank account and realizes they can no longer afford the life their parents had. They are being told the economy is great while they are drowning in the bathtub. The middle class is not just shrinking, it is being liquidated to pay for the gains of the elite. And if you think this is just a European problem, you are not paying attention. This is the global blueprint. Now, we are all living in a K-shaped world now. The primary reason we cannot rely on our salaries anymore is that growth has left the building. We are no longer in an era where hard work and a steady paycheck lead to a comfortable retirement. That path has been washed away by the tide of liquidity. So how do you actually navigate this? Step one is to stop thinking like a consumer and start thinking like a custodian of capital. You have to realize that cash is no longer a safe harbor, it is a melting ice cube. Step 2 is to identify the assets that the central banks are forced to pump. They have no choice but to keep the stock market and the housing market from collapsing, because if those go down, the entire banking system goes with them. Step 3 is to understand the difference between price and value. Price is what you pay, but value is what you keep after the currency has been debased. I often get asked if we should just wait for the big crash to buy in, but here is the catch. The central banks are so terrified of a 2008-style collapse that they will do anything to prevent it. They will destroy the currency before they let the nominal price of assets fall. This is why the debt keeps growing and the printing never stops. We are in a game of musical chairs where the government keeps adding more chairs made of cardboard just to keep the music playing. But as we look toward the future, we have to ask ourselves how much longer this can last. There are physical limits to how much we can grow even with infinite money. We are running into the reality of resources and the reality of human beings. The next decade is not going to be about who can print the most money, but about who can control the things that money can no longer buy. Before we move on to the physical limits of our world and why even AI might not be the savior we expect, I want you to look at your own portfolio. Are you holding the things that the government can print, or are you holding the things they can only dream of owning? The answer will determine if you stay on the top half of that K or if you slide down with the rest of history, because the wave is getting bigger and the shore is getting farther away. We have been living in a world of digital dreams where we think that numbers on a screen can grow forever without touching the earth. But there is a cold, hard reality that no central banker can print away, and that is the law of physics. Warren Buffett often talks about the law of large numbers. In simple terms, imagine you are a small child growing 6 inches in a year. That is incredible and exciting. But if you kept growing at that rate by the time you were 30, you would be 50 feet tall. You would collapse under your own weight because your bones could not support the mass. This is where the global economy sits today. We have become so big that the resources required to move the needle even a tiny bit are becoming impossible to find. Most people believe that technology is a magic wand that solves every problem. They think that as long as we have silicon chips and artificial intelligence, we do not need to worry about the physical world. This is the great myth of our time. The truth is that the more digital we become, the more physical matter we actually consume. Look at the AI revolution that everyone is betting their retirement on. We talk about the cloud as if it is made of air, but it is actually made of massive data centers that require staggering amounts of electricity, copper, and silver. To make AI work at the scale the world wants, we would need to mine more copper in the next 20 years than humanity has mined in the last 10,000 years combined. This is the energy trap. We can develop software at the speed of light, but we can only dig holes in the ground at the speed of a shovel. When the demand for these metals explodes, the price of everything else follows, because you cannot build an electric car, a windmill, or a supercomputer without them. This creates a ceiling on growth that no amount of low interest rates can break through. We are seeing this right now in the commodity markets, where prices are detaching from the reality of the average consumer. The world is getting more expensive, not because we are richer, but because the earth is finally charging us the true cost of our ambition. Then there is the human element. The engine of any economy is people working and people buying. For the last 50 years, we have had a massive tailwind of young workers entering the force and spending money. But that wind has died down and is now blowing in our faces. In almost every developed nation, from the United States to Canada and across the ocean, the birth rates have fallen off a cliff. We are looking at a future where the next generation is half the size of the one that is retiring. When you have fewer people, you have less demand, and when you have less demand, you have no growth. Larry Summers from Harvard calls this secular stagnation. It is a fancy way of saying we are in a chronic state of low energy. He argues that because of extreme inequality, where the top 1% has all the cash, and the bottom 80% is struggling, the money just sits there. It does not circulate. It does not create new factories or new jobs. It just waits in offshore accounts or gets pumped back into share buybacks. This is why the growth numbers I mentioned earlier are so low. We are starving the engine of fuel while wondering why the car is slowing down. So how do you survive a world that has stopped growing but keeps getting more expensive? Step 1 is to realize that the most valuable things in the next decade will be the things you can actually touch. We are moving from the era of bits back to the era of atoms. If you are only invested in software and digital promises, you are vulnerable to the resource wall. Step 2 is to look for companies that own the infrastructure of the future, not just the apps that run on it. Think about the power grids, the water systems, and the mineral rights. Step 3 is to prepare for a permanent state of higher inflation. The days of 2% inflation were a historical accident caused by cheap labor in Asia and cheap energy. Both of those are gone. I often hear people ask if AI will eventually fix this by making us so productive that growth returns. It is possible, but remember the history of the IT revolution. When computers first arrived in the 80s, it took more than 15 years for them to actually show up in the productivity data. AI is a powerful tool, but it has to be integrated into a physical world that is currently rusting and shrinking. It is not going to be a quick fix. It is going to be a long and expensive transition. We are standing at a crossroads where the old map of constant expansion is no longer working. The experts keep telling you that a recovery is just around the corner, but they are looking in the rearview mirror. The road ahead is narrow and it is steep. But for those who understand that the rules have changed, there is a way to stay ahead of the curve. You have to stop chasing the ghost of 90s growth and start positioning yourself for the reality of 2026. If you think the struggle for resources is intense, now wait until the political winds shift. Because in a world without growth, the only way to get ahead is to take from someone else. And that is exactly what the next phase of the global game is about. In the next chapter, we are going to look at the massive political shift coming in 2026 and how the change in leadership at the most powerful financial institution on earth will change the value of every dollar you own. The year 2026 is not just another date on the calendar, it is the year the guardrails finally come off. For years, we have relied on a semi-independent Federal Reserve to at least pretend they care about the long-term stability of the dollar. But that era ends in May. Jerome Powell, the man who has spent years trying to balance the scales between inflation and employment, is packing his bags. And in his place, we are likely to see the birth of the political Fed. Think about the incentives of a leader like Donald Trump. He is a man who understands the psychology of the crowd better than almost anyone in history. He knows that as long as the numbers on the screen are green, people feel happy, and when people feel happy, they do not look too closely at the debt. He has spent his entire career as a builder and a borrower. To him, a low interest rate is not a financial policy, it is a birthright. When he puts his hand-picked loyalists into the seat of power, the goal will not be to save the dollar. The goal will be to make the stock market roar at any cost. There is a term in politics called NIMT, which stands for not in my term if you please. It is the ultimate strategy of the modern politician. Every leader knows that the debt bomb is going to explode eventually, but they all have the same goal to make sure it happens while the other guy is in office. So they kick the can down the road. They print more money, they cut taxes for the wealthy to stimulate short-term spending, and they pressure the central banks to keep the juice flowing. This creates a massive artificial high. It is like a runner using every drug available to win a sprint while his organs are failing. This is the environment we are entering in 2026. We are going to see a flood of liquidity that will make the pandemic era look like a dry spell. Why? Because the government has no other choice. They cannot raise taxes enough to pay the debt, and they cannot stop spending without causing a depression. So they will choose the only path left, which is to inflate the debt away. They will make the money worth less, so the debt feels smaller. But in that process, they will also make your savings worth less. So what does a winning strategy look like in this new paradigm? We have to build what I call the Noah's Ark portfolio. You have to realize that the stock market and gold are no longer just places to make a profit, they are lifeboats. When the currency is sinking, you do not want to be standing on the dock holding a suitcase full of cash. You want to be on the boat. This is why the S&P 500 and gold have decoupled from the reality of the average worker. They are the only places left to hide from the melting dollar. But here's where most people get it wrong. They ask for a single stock pick or a magic button they can press to get rich. That is a recipe for disaster. Your portfolio has to be as unique as your own life. If you are 30 years old and you have a steady income from a job, your risk tolerance should be vastly different than someone who is 60 and looking to retire next year. The 30-year-old can afford to ride the volatility of the tech sector because they have time to wait for the next wave of printing. But the retiree needs to focus on cash flow and hard assets that provide a hedge against the rising cost of living. I often get asked the same question over and over. Sean, is the market too high to buy in now? Should I wait for the crash? Here is the uncomfortable truth. In a world of infinite money printing, there may never be a crash in nominal terms. The price of the S&P 500 could go to 50,000, while the price of a loaf of bread goes to $50. If you wait for a 50% drop in price, you might find yourself waiting while the value of your cash drops 70%. You cannot measure the market in dollars anymore. You have to measure it in purchasing power. We are moving into a season where the winners will be those who can see through the fog of the numbers. You have to look at the global capital flows. You have to see where the big players are moving their chips. They are moving away from government bonds and into things that cannot be printed. Real estate in prime locations, energy infrastructure, and the companies that own the intellectual property of the next decade. The strategy for 2026 is simple but difficult to execute. It requires you to ignore the headlines and the fear and focus on the mechanics of the system. We are in a cycle of permanent devaluation, and the only way to win is to own the things that the government is trying to buy back with their printed paper. But as we move toward the final roadmap for this year, we have to look at the one thing that matters more than any stock or any bond, and that is your own economic sovereignty. We have spent this time looking at the macro forces and the political shifts, but the most dangerous thing you can do is remain a passenger in your own life. The wave is coming, and it is bigger than anything we have seen in our lifetimes. The question is not whether the system will change, but whether you will be the one driving the change for your own future.